Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Today, we are putting the spotlight on loans. Now, why are we doing that? The RBI has begun its rate cut cycle, and there are several cuts ahead if you go by what market pundits say. So is this a good time to perhaps take stock of all your borrowings and find ways of maybe even reducing your overall debt pie? How can a borrower take advantage of rate movements to reduce the cost of credit? And what are the key things to keep in mind in case you are thinking of taking a new loan? To talk about all of this, we have two experts with us. I have Prithvi, Chandrashekhar, CEO of Consumer Finance at InCred Finance, right here with me in the studio. And Radhika, Binani, Chief Product Officer at Paisa Bazaar, is also joining in to help us make smarter decisions when it comes to our borrowing. So Radhika and Prithvi, great to have you both on the program. Welcome in. Let me start with one basic question. In my preamble, I said that this is the starting of the rate cut cycle because that's what we keep hearing from experts. Would you agree that this would be a good time for some debt house cleaning for all the borrowers out there? Radhika?
Yes, definitely. It's a good time to look at what our debts, how our debts add up. It's a spring cleaning time. The cut in repo rates is a good indicator for us to look inwards, look at our finances, and take advantage of how do we end up saving money on the debts that we have taken.
Okay, all right. Prithvi, your opening thoughts on this rate cut cycle that's now begun?
Two thoughts, Surabhi. First is any time's a good time for debt consolidation. What we've seen over the last 5-10 years is a lot of retail borrowers in India have accumulated a large number of small ticket, high rate loans and bringing them together into a single umbrella with a longer tenure and a lower rate totally makes sense. If the repo rate cut triggers some of that, great. However, the word of caution I'd throw out there is forecasting interest rates is a very, very difficult business.
Sure.
There are lots of pros who've tried to build their careers doing that, and mostly they fail. So for our consumers, I would almost say don't bank on rates continuing to go down. It's hostage to many things that happen in the world around us, which are intrinsically unpredictable. But if you have a lot of small ticket, high rate loans, do consolidate it. You'll save a lot of money, improve your credit history, plenty of benefit to doing that. Just don't link that to, the rate cycle.
Fair enough, fair point, but which is why I guess even Radhika is saying any time is a good time to do some spring cleaning when it comes to a lot of multiple loans that you might have accumulated. Now, I want to ask both of you a very simple phenomenon. We all know that floating rate loans should automatically keep readjusting as, the RBI cuts rates. But in reality, in the practical sense, I've had friends and family members one day wake up and say, hey, apparently rates were cut last month or 2 months back, but I'm still paying this much on my home loan or this much on a personal loan. So this whole concept of very transparent, automatic, clear transmission, Radhika, is that a bit of a utopian concept?
I don't think so. As long as the external benchmarks are being benchmarked to in your loan document, it will be clearly outlined what is the interest rate linked to. As long as it's external benchmark, the rate transition is automatic. But whenever the interest reset times are outlined as per the loan document. So we need to be clear about when the loan document. So if the rate cut, say, for example, happened in, say, February, hypothetically, and the loan reset date could be June for that particular bank or that particular lender. So it will start happening from June onwards. It's not as if as soon as the RBI announces, the rate transmission will happen. However, as a consumer, I think it's best for us to be alert and not assume things are working as it should work. Can always check back with the bank and they would give you when is the next reset date and what is it likely to be. So that's one thing. Second is they can, if you believe that the transmission has not happened as per for the last few years, as per how the interest rates have moved, it's always okay to explore balance transfer options and figure out how much is the current interest rate that you will get if you were to make that a new loan. And there is always a cost save to have, especially in a long tenor loan and a high value loan like home loans. So so one should go back and check periodically also what's the interest rate revision that has happened.
No, absolutely. We need to be alert as consumers and customers ourselves to, make sure that we take the full advantage of a changing rate environment. On this, Prithvi, I want to ask you, let's explain the concept of external benchmark rates very clearly to our viewers. What loans are externally benchmarked, and then what happens to the fixed loan that I might have? What recourse can I take there?
So the benchmarks are typically with the repo rate in India or equivalents of the repo rate, and it's similar around the world. That's basically the rate at which commercial banks can borrow from the RBI. And that's an input cost for the banks.
Yeah.
So when that rate is cut, their cost of inputs, the bank's cost of inputs comes down.
Yeah.
And they can typically lend more at a lower rate. And conversely, when the RBI raises the repo rate, the banks tend to lend less and at a higher rate. Now, this is an ongoing process.
Yeah.
Central banks around the world are changing the benchmark actively to manage the economy.
Yeah.
Now, some loans are floating loans where the interest rate that you pay is linked to the repo rate or
So
an equivalent.
that's what I'm trying to understand, that for most of these floating rate loans, would that external benchmark be the repo itself, the RBI's repo rate, or do they follow some other external benchmarks? What's popular in the market?
The repo rate is the most common one.
Okay.
It's the most common one. The thought I'd share, though, is that most consumer loans in India are not floating.
Yeah.
And this is by design because right now the rates are falling. They can also rise. And across the cycle, fixed rates give the consumer predictability, which they tend to value. So right now, if you want to take advantage of the falling rate cycle, I would echo what Radhika said. Probably the best way of doing that is through a BT, which is a balance transfer,
Okay.
which you will get cheaper today than you would have got 6 months ago because of the falling rate environment, right? Rather than trying to just ride the rate cycle without any active, steps that you take to control the rate. Because personal loans, credit cards, most auto loans, a lot of small ticket mortgages, unsecured business loans, which are used by self-employed people, a lot of these are actually fixed rate loans. And that's for a good reason, which is it offers the consumer predictability. But that also means the transmission of the lower rates through the system happens much more slowly than you would intuitively expect.
Radhika, coming to you on this, so like you explained and like how Prithvi is explaining it, that for floating loans, your home loan or maybe your car loan, eventually, like you said, when the reset happens, you should get the advantage of the lower rate. The problem is high cost fixed loans. That's what Prithvi is saying. A lot of the consumer loans actually are fixed loans. So what should I as a borrower be doing if I realize that I'm sitting on a 12-13% high cost fixed loan?
First step is you go to your existing banker and ask what is the best way for me to manage at this point of time. Can I move from fixed to floating? Some lenders agree and some might not. The second step is to look at coming back to the basic again, which is balance transfer. You could look at marketplaces like ours where there are various lenders and look at what is the best rate which is getting offered for your credit profile and your income profile. And look at what are the options that you have and do a balance transfer. Weigh it against the processing fee and the money and the outstanding amount that you have. For example, if it's a 5-year car loan and you're already at 4 years plus, so the amount of processing fee plus the hassle of changing it might not be worth the amount you will be saving. But on the other hand, if it's a 20-year home loan and you've paid only 5 years and there is 15 years of repayment pending, so then definitely it makes a lot of financial sense to get the balance transfer going, because there is, again, you will be treated like a new consumer. So you'll have to do the entire processing of documentation again, but it's well worth it. And there are also balance transfer calculators for you to calculate what is the interest saving over the tenor, balance tenor. So it could run up to lakhs if you are talking about fixed versus floating, especially in a falling rate cycle. Plus also, I think while Prithvi talked about consumer loans being mostly fixed, but typically high value loans are mostly floating. So even in floating, because there there will be an interest cycle. So 20-year is a long period, so there will be interest cycles. So there is always opportunities for us to keep looking at how do we do the transfers intelligently to help you make save money, but at the same time balancing with the processing cost as well as the processing time and energy that you spend.
You know, since both of you are saying that balance transfer is a great tool to reduce, perhaps in many cases, maybe it can help you reduce your cost of borrowing. I want to get your sense on this whole concept of the balance transfer. And typically, you know, if there are any rules that apply. So Prithvi, is it that, let's say, maybe smaller banks who are looking for business or smaller NBFCs, can they be a good option for a balance transfer? Do they give cheaper rates, or is it big banks because they're big and size matters? I want to know if there's any method to the madness when you're out shopping for a better rate.
Typically, the biggest banks can offer the best rates because their cost of funds are lower. Typically, what happens is that the smaller, higher price loans are from smaller organizations, NBFCs or smaller banks. And the consolidation happens to a big bank. But there are hundreds of exceptions, right? I mean, if you're transferring to a Tata Capital or an Aditya Birla Capital, you could actually get a bank-like loan.
Because they're giant NBFCs.
They're giants anyway.
Yeah.
I mean, they're actually NBFCs, but they're bigger than many banks in the country.
True.
So it's not a generalization saying, you know, that the BT out will happen to a bank, but the bigger organizations with a lower cost of funds are typically the destinations of the BT.
Got it. Radhika, very quickly, before we take a break, your take on the same thing. If I have to shop around for a smarter loan and do a balance transfer, then do any house rules apply?
Yeah, like Prithvi said, the rules, you make it on the go. But yes, basically the brand names don't play much. It's not a bank versus any other organization. Yes, the larger banks and larger organizations will help you get better deals on the loan. So you'll have to look out for what is the size of loan they're offering, what is the interest rate, of course, because like sometimes the NBFCs could have a slightly higher interest rate than a bank. So you have to look at size of loan you're getting, the interest rate, the processing times, and the processing fee, which is this one. These are the 4 things which you look at and compare and then take the best bet.
All right. Sounds very, very logical. We do have to take a quick break on that note. We come back on the other side and then we talk about people who want to take a fresh loan right now. Maybe a new house, maybe a new car, maybe some big ticket, spends in terms of home improvement. So how should they go about it? We'll discuss it on the other side.
Let's talk money.
Welcome back. This week, we're talking about how you as borrowers can benefit from the fact that the RBI has once again started cutting interest rates. And the expectation is that the rate cut cycle should see at least a couple more cuts come through. So, of course, we've got both Radhika as well as Prithvi right here with us, and we're carrying on the conversation. Now let's talk about people who want to take fresh loans. And, typically when we talk about a rate cut cycle, people get a little, invigorated to think about whether now I should buy a car, maybe, take the plunge, buy that house. So how should one go about it? And, what would your suggestion or advice be, Radhika?
Firstly, the tail cannot wag the dog. So you need to buy, if it is in your financial plan to have a house or a car, is when you should start thinking about buying that. It's not because it cannot be triggered by interest rate cycles. So in that sense, assuming that it's part of your larger financial plan that you want to be a homeowner, you should consider that.
Sometimes, Radhika, I take your point. I take your point completely. I was just saying sometimes, the fence sitters, sometimes when they start seeing the headlines on big rate cuts, something that you've been avoiding or you've been sitting on the fence, at times it can be a trigger. That's where I was coming from. But please continue.
Yeah, thanks. So home loan is a 20-year kind of an investment. Typically, the average, you take the loan for 20 years. So at 20 years, invariably, there will be 2 or 3 credit cycles. Not many people can predict, but there would be eventually 2 to 3 credit cycles in a 20-year period. So you definitely cannot time the market because you'll have to go through those 2-3 cycles irrespective of where you start. So in that sense, you would get opportunities to be able to balance transfer if the interest rates go down. And similarly, when the interest rates are going up, your loan will get repriced. So as long as home loan is concerned, there is never, as in the home loan rate cut is not going to be a trigger. You should continue with your plans of buying a house, and if you're sitting on the fence, it's a good time to start buying the house as long as it's part of your larger financial plan. Now coming to shorter term loans like a car loan. So car loan, definitely, if you're a fence sitting and you believe that car loan makes sense because it's a depreciating asset compared to a home loan. So if it makes sense and it's only because of the home loan you're trying to optimize, I think car loans you could start exploring, and later you can reprice it. You can go in for a floating rate and you can reprice it in case it's going to bottom out further. You could net. The point is you can't time it. We are not economists. We cannot time it. Like Prithvi had mentioned in the past, people try to predict but end up not being able to do that. So, but since it's a floating rate, you have the advantage of repricing, balance transfers, looking at marketplaces, and being able to take the right decision at different points of time. And it's fairly transparent. It is a good time to start off in case you are sitting on the fence, and it's part of your larger financial plan.
Okay, absolutely makes perfect sense. Now let's talk about the whole balance transfer concept, because both our guests touched upon it, and that could be a great way to lower your overall cost of borrowings, perhaps get rid of certain, legacy loans on which you're still paying high interest rates. So Prithvi, basic question here is, remind us of the big categories where the rate of interest tends to be fixed. Like you said, most personal loans, it's fixed. What are the other loans where you might be stuck with a higher cost old loan, which may now need to be sort of relooked at?
The type of loan is actually not the key. The real question is, is it a fixed rate loan or is it a floating loan? And you could have fixed rate and floating loans in pretty much any product.
Sure.
So you could, personal loans, credit cards, consumer durable, they're almost always fixed.
Yeah.
But something like a mortgage, there are several fixed mortgages and there are several floating ones as well.
Yes.
Or similarly for car loans or auto loans, they're in the middle.
Okay.
Now, if you've got debt which is on a fixed pricing schedule, now is a great time to basically take a bigger loan at a lower rate.
Okay.
Ideally using both the reducing repo rate and your now much stronger credit history to get a big pot of money, use it to settle and close all these small loans.
Okay.
And pay a much smaller EMI over a longer tenure and save yourself some money.
So give us an example of that. And, are such loans easily available? Because if I go to the lender and I tell them I have 5 outstanding loans, 7 lakhs here, 10 lakhs here, 4 lakhs here and there, and then I want to consolidate all into one loan. First of all, what kind of a loan will that be, this big consolidation loan? And again, what could be the rates of interest? What could be the processing charges? What all should I keep in mind when I'm looking at consolidating all my debt into a lower price loan?
It's a great question. Typically, it's a unsecured loan. It's a bigger unsecured loan.
Okay.
In principle, it could even be a secured loan.
Okay.
When I worked in other countries, I've seen, basically home equity being a way of borrowing at a low cost.
Okay.
And using home equity to close off a lot of, higher priced loans like credit card debt. I don't think that cycle is as well oiled yet in India as it needs to be. But things like the repo rate cut we've just seen could actually trigger that.
Radhika, very quickly, we're running out of time. Same question to you. What loans should I look for if I want to consolidate a lot of my higher cost debt? And overall, what are the things to keep in mind when I'm doing this sort of a consolidation / balance transfer?
Yeah, I think Prithvi covered it in detail, but one aspect which we are seeing and also could encourage consumers is making your assets work for you. So over time, people have accumulated, say, gold, mutual funds, and they have a car or even they might have a property. So taking a loan against any of your secured your assets, converting them into a secured loan is a very smart way of getting yourself a loan which can use to repay your other high value loans. Because typically secured loans are the interest rates are much lower. You can get at least 50 to 70% of loan to value. So if your property value is 20 lakhs, you could get up to 14 lakhs of my loan. Or even if you have gold for 5 lakhs, you could mortgage it and get around 3.5 lakhs of loan. So making your assets work for you taking a secured loan is one smart strategy of debt consolidation. What also it helps you, it's an additional supplementary benefit, is that in your credit profile, your mix of unsecured and secured loans improves. So if a person has more secured loans than unsecured, your credit score improves, and that's a great plus for consumers. The strategy is not known to many, but I think now with people investing in stock markets and having that portfolio, loan against mutual funds, all of that is coming up, and there is demand which is coming up, which we can see on our platform.
Absolutely, and that's a great strategy. Thank you for sharing that. Those are the ways. Take a secured loan against assets and pay off a lot of the old high-cost debt. Radhika, very quickly, last 30 seconds left. Now, recap for us the checklist, the hygiene elements that we should always check before deciding to take that loan. It could be any loan.
The amount of loan which you want to what you are getting, interest rate, processing time, processing fee, and accessibility post-loan, so post-loan serviceability. These are the 5 things which you can check. Additionally, one small point, it's almost like a hack. When you're taking a home loan, go with a larger bank, because the property will be scrutinized, and you can be sure that property you're buying is of great value. So that's just a hack.
Okay, absolutely. Another great piece of advice, that you can have a clean title. You can reasonably have a peaceful night's sleep if the bank has done the due diligence for you. Well, thanks very much, Radhika and Prithvi. This is a very helpful conversation, and hopefully our viewers will make use of it to improve their overall debt profile. Thank you for watching. Well, we're out of time on this edition of Let's Talk Money. Keep sending us your feedback, comments, and queries. See you again next week.
Let's talk money.